Hello, my friends. Today is May 6th. My name is Joseph, and this is Markets Weekly. Now, this week was super exciting, so we have a lot to talk about. First and foremost, of course, we're going to talk about the implosion in regional bank stock prices. I was saying that the regional bank panic is over, and then we see their stock prices implode. Seems like it's ongoing, or maybe things are not necessarily what they appear to be. We'll talk about it. Secondly, we'll talk about the update the Treasury offered us on its projected issuance over the coming years. And lastly, we'll talk about the big data print this week, that is the non-farm payroll print. Okay, starting with the regional bank stock price implosion. So, of course, over the weekend, First Republic was bought by JP Morgan, and things seem to be going well. Chair Powell had his press conference, and he told us that from what he sees, things are broadly getting better. Jamie Dimon, of course, suggested the same thing. And then right after his press conference, we see a few stock prices of the regional banks just completely implode by 30%. And the day after, they continue to sink. Notably, there was Pacific Western and Western Alliance, which I'm showing here. You can see that things were stabilizing, and then poof, they kind of fell off a cliff. Now, a wide range of regional banks were impacted. The smaller ones particularly so, but even the bigger ones like PNC, US Bank, they were also sold. Now, this is kind of interesting in a sense. Now, let's think back a month ago. So, Silicon Valley Bank, First Republic were having tremendous deposit withdrawals. Their depositors, mostly tech companies, were running from them. So they were under a bank run, and you saw their stock price reflect that, just basically plummet. This time, though, it's a little bit different because during this episode, Western Alliance actually came out and issued a statement. And they said that, I'm sitting in my office and I'm looking at my own books, and the bank has not experienced unusual deposit flows following the sale of First Republic Bank and other recent industry news. Total deposits were $48.8 billion as of Tuesday, May 2nd, up $48.2 billion as of Monday, May 1st, and flat to Friday, April 28th. So they're saying that, gosh, guys, nothing has changed for us. There's no deposit flight, there's no bank run, but then the stock price seems to tell a different story. Now, if there's nothing actually going on with the bank, why is the stock price declining? Well, there's a reporter at the Wall Street Journal called Eric Wellerstein, who is a really good reporter and who actually used to work with me at the Fed. He did some digging into this, and he discovered this. Now, this is the options volumes for Pacific West and Western Alliance. And from this chart, you can actually see that, yes, there wasn't that much options volumes. Earlier in the year, we had some around the collapse of Silicon Valley Bank. And just this past week, they absolutely soared. Put option volumes for these guys were to the moon, all-time highs. And as we've learned during the meme stock episode, when everyone goes and buys a lot of call options, say on AMC or GameStop, that can make the underlying stock price go to the moon. And it seems like some people also discovered that when you buy a whole lot of put options, the reverse can also happen. So it's when you're looking at stock prices, there is some connection to the actual company, just like there's some connection between the stock market and the real economy, but it's some connection. It's not necessarily the same thing. Stock prices, like anything else, is just supply and demand. Market participants buy and sell for different reasons, not necessarily because they have a view on the company. Obviously, when everyone went and bought call options on GameStop, I don't think they were thinking that the GameStop company was just a super great business, the same with AMC, but they understood that if they bought a lot of those call options and the stock went up, well, they would make money. And I think you have a similar occurrence here, where a lot of people bought put options, and dealers, because they take the other side of the trade, have to sell the underlying to hedge themselves. So that pushes the stock price lower in the same way that buying call options pushes the stock price higher. Okay, so that seems to be the driver of these stock prices. Now, I noted earlier that there doesn't seem to be anything wrong with the banks, but here's the thing though. Now, most depositors in a bank don't really pay close attention to what's actually going on in the bank. All they see are the stock price. So if they see the stock of their bank tank, then they're going to panic. And so what was a okay bank, totally normal, totally stabilizing, could actually end up in a bad situation. A tanking stock price could precipitate a bank run. So we're in this situation here. In a sense, it's kind of like being able to buy insurance on your neighbor's house. So you buy a lot of insurance and you set fire to their house. Perception can influence reality when it comes to banks, especially in a climate where there's some degree of nervousness. So I think this has to be something that we watch closely. Now, there's also rumors right now that the SEC may institute a short sale ban on banks. They did that during the Great Financial Crisis as well. But we want to watch to see if the sentiment improves, because if it doesn't improve, and every day, even though there's nothing wrong with the bank, people seeing the stock price of the bank tank, they can actually get nervous and actually precipitate a run. And that's not really what we want to happen. We want banks to survive. Those banks employ people. They make loans to the real economy. It's in our interest, in everyone's interest actually, except the certain investors, for good businesses to survive. Now, I also want to address a couple topics that I've been hearing a lot. Those topics are saying that regional banks are not tanking because of these options, but they're tanking because of poor fundamentals. Now, again, we have a temptation to link fundamentals with market prices directly, some relationship, but not really strong. But I think those objections are worthy of addressing. The first objection is that these banks are having tremendous deposit runs because they're not willing to pay up for deposits. And so they can't compete with money market funds. So all the depositors are taking their deposits out of the bank and leaving for money market funds. And the banks, they can't afford to pay higher deposit rates because their assets are lower yielding. So that means that if they actually raise their deposit rates to compete with money market funds, they'll go broke. And so because the bank is in a no-win situation, their business models are broken, and so their stock prices should be very low. That objection is very obviously not true, and I want to go over why in just a moment. Now, the second objection that I hear about is that banks are basically insolvent because the Fed raised rates aggressively, and so a lot of their assets, who are perhaps longer dated, perhaps fixed income securities, they declined in market price following the aggressive rate hikes. Because the banks are insolvent, their equities, of course, should be zero. Now, that is definitely nonsense. Okay, now first in order to talk about why these two arguments are without merit, in my view, I'm going to pull up the investor presentation from Western Alliance Bancorp, which is one of the highlighted banks in this week's stock market price declines. Before I go into that, one more thing worth mentioning. So the Financial Times reported that Western Alliance was exploring a sale. Of course, if you're selling yourself, you're probably going to fail. And its stock price tanked because of that. It turns out that was a fake story. So Western Alliance immediately disputed that, issued a press release, and is saying that they're going to sue the Financial Times. So again, you have huge speculative positioning, and then you have what appears to be fake news. So there could be something more to this than what appears on the surface. Okay, now here is the interest-bearing deposits of Western Alliance. Regional bank, not like a big bank, not particularly important. But what you want to notice is that even as the Fed hiked rates to about 5%, their interest-bearing deposit costs are about 2.75%. So when the Fed hikes rates, it never completely flows through to the depositors. That's never been the case. Usually, let's say about 40%, 50% flows through. The bank doesn't actually have to pass through the entire rate hike to the consumer because the consumer is able to get benefits from the banks in other ways. And this has always been the case. And again, we all bank with someone, so we should have this in our own experience. Banks try to retain depositors, not necessarily through interest rates, though some people care a lot about that, but they can also do a lot of other things. A common thing in the 80s was they would give you a free toaster. But today they could also offer things like, you know, business loans, mortgage loans, good, cool technology. Or if you're a business, they could very much offer payment processing services, treasury functions. So let's say you're a business with 100 employees. Every month you have to make payroll for 100 employees. Well, that's a processing thing that the bank could do as a service. And in exchange, the bank would maybe not pay you as much interest. Anyway, the fact is that banks don't purely compete on interest rates. So that's why even as the Fed rate hikes rates, banks have to pay more in interest, but it's never in the sense that they can't handle it. If there was ever an instance where they would not be able to afford deposit interest payments, if it was ever an experience where they had lots of depositor flight because of interest rates, they could simply raise the interest rates to stop them. It's a really, really easy thing to fix. One other thing that I would note here is that in this example, again, Western Alliance, not a super important bank, 35% of their deposits are non-interest bearing. So you got the interest bearing deposits paying 2.75%, and then 35% of their deposits don't even bear an interest. So again, Fed hikes rates, the interest rate costs for a bank rise, but just by a little, because the bank is all able to compete in other areas of service as well. Okay, now the second thing related to what was mentioned is that the banks can't offer higher payments because if they do offer higher interest on their deposits, their asset side is really low. They'll go broke through negative carry. Their interest income will be lower than their interest expense. And that's really obviously not true either. So again, just looking at Western Alliance, not a particularly special bank. Now their investment portfolio, so their securities, things like treasuries and agency MBS and other things like that, munis, yields, investment yields increased to 4.69%. Again, far above what they're paying on their deposits. Now, notice that they only have $9.1 billion in investments. Like any other bank, most of their assets are in loans. And here we see $46 billion in loans. $46 billion in loans. And what are they receiving on loans? 6.45%. Okay, so again, the bank is making a good interest margin. All banks are making good interest margins. So when people are saying that the banks can't afford to hike deposit rates, obviously not true. Can easily afford to. Now, the second argument that I'd like to address is that the banks are insolvent. My gosh, Fed hiked a bunch of rates, all their fixed income securities, fixed rate loans, underwater, they must be insolvent. So that is a much trickier question to answer. And I'll answer it using an example. Now, when you're talking about solvency, it's assets minus liabilities, right? So we know that the assets prices have declined because interest rates went higher. Now, what about the liabilities? In case A, let's say the bank borrows overnight $100 and uses it to purchase $100 worth of mortgages. Fed hikes rates, mortgages decline in price from $100 to $90. Now all those overnight lenders see that the bank, oh my gosh, you lost $10. I want all my money back. The bank is forced to sell that mortgage, realizes a $10 loss, and goes broke because they only have $90 worth of assets and they have to repay $100 worth of loans. That's case A. Now let's go to case B. The bank borrows $100 in 10-year loans and invests it in 10-year treasuries or 10-year security. Interest rates go higher. Yes, that 10-year security that they own declines in price. Oh no. But let's say after 10 years, of course, because the 10-year Treasury security is money good, then at the end of the day, the bank receives $100 back. So it doesn't have any losses. Over the course of the 10-year period, the market value converges to the par value because all you're seeing is fluctuations in price due to interest rate risk. There's no credit risk. So the bank holds the security over to maturity and it pays down 100 cents to the dollar. And at the same time, because the bank borrowed a 10-year loan to fund that investment, it has $100 and it can use that $100 to pay off the 10-year loan. No loss to the bank. Bank is not insolvent. Now, the key difference between these two cases, between case A and case B, is that in one case, the bank borrowed in overnight money. In the other case, the bank borrowed 10-year money. Now, a deposit, is it overnight money or is it 10-year money? Well, in practice, of course, no one goes to the bank the next day and takes back all their deposits. That doesn't happen. But it's also true that no one keeps their money in a bank forever. So it's also not 10-year money. It's somewhere in between. Now, therein lies the detail. If I'm a bank and I have someone depositing money with me, when is that person going to take their money out? They're not going to take it all out tomorrow, and they're not going to leave it in forever. So I have to have an estimate as to when someone will take that money out. In a sense, I'm borrowing term money. I'm not borrowing overnight, I'm borrowing term. I just don't know exactly what term it is. Now, banks try to estimate that based on who is making the deposit. Is it a retail mom and pop guaranteed by FDIC insurance? And there's a good chance that they're going to keep their money there for a long time. Maybe I can estimate it to be 5-year money, as in like a 5-year loan to the bank. Or it could be someone like a Silicon Valley investor who has lots of uninsured money and is very volatile. Well, maybe that's closer to overnight money. So a bank would try to understand its clients and try to build relationships to make its money stickier. But it's an art more than a science. So First Republic's strategy was to go find lots of really rich people and ask them to keep their money with First Republic, but in exchange offer them really, really sweet mortgage deals. So super low rates on their big mortgages. Silicon Valley Bank's strategy was to find a whole bunch of startups and offer them loans when no one else was willing to offer them loans, on the condition that they would keep their deposits with Silicon Valley Bank. Again, these are banks trying to control the stickiness of their deposits. It turns out those two strategies did not work. What was thought to be, let's say, a long-term loan to the bank ended up to be an overnight loan to the bank, and the bank went bust. So how you run your bank, how you manage your deposit franchise, which is what they call it, really determines how sticky your money is, and thus whether or not your bank actually is insolvent when it has losses on its assets. The vast majority of banks in the US manage their banks very conservatively. They have a high degree of deposit granularity. That is to say, rather than having a few rich people or a few big VCs, they would have 10,000 mom and pops leaving $10,000 in the banks. Those banks are super sturdy. Now, from what I see, the vast majority of banks really are like that. And I know it sounds crazy, but if you really think about what happened during the banking episode, it was really concentrated in more volatile sectors. Let's say VC and crypto, and those sectors went bust, and the banks that relied on them as customers went bust with them. So we'll see going forward if there really is more trouble, or really this was just a panic driven by stock prices. Definitely something to watch in the coming weeks. All right, let's go on to our next topic. Okay, now this is what I find to be the craziest thing. So every quarter, the US Treasury updates us with what they're doing with their Treasury issuance. What are they projecting for the next few years? Now, here you want to look at the dots here. So these are dots based on the projections of the private sector. So the banks, and also the projections of the OMB, which is a government agency, and the CBO as well. So the triangle is the OMB. I forgot the acronym. It's one of the government agencies, and the Congressional Budget Office is the blue dots, and the square is from the private sector. So what you want to see here is that the net issuance of treasuries, in another way, the deficit, is going to be between $1.5 to $2 trillion for the next 5 years. Now, I want to rewind a little bit. 20 years ago, we didn't really have much of a budget deficit. 30 years ago, we had budget surpluses. There was a lot of people in Congress who cared a lot about the budget deficit. Those people are all gone now, and we really are in a very, very different era. We are in an era where no one cares about the budget deficit. And so that has two implications. One, if you continue to have fiscal spending, it's really hard to get inflation under control because you have basically a huge price-insensitive market participant. Now, in the economy, if prices get too high, people can't afford them, and so prices come down. But if you have the government in there, of course, the government is never going to say that prices are too high, I'm not going to afford it. They're just going to print treasuries to afford it. So if you have a government that continues to deficit spend, well, that's inelastic demand, and that seems to continue. Now, the second thing I'll note is that now treasury yield, treasury prices, again, like anything else, it's supply and demand. People look at treasuries from a wide range of angles. Some people have to buy treasuries because they're highly regulated. Some people are macro investors. They look at things like growth and inflation. Other people are like foreign central banks who have a whole bunch of dollars they need to invest, so they don't really care about inflation and things like that. Again, if you want to understand how markets work, you really have to see things through the perspective of different market participants. I really recommend my free course at centralbanking101.com about this. Now, anyway, the thing is that you have demand side, totally different people, totally different participants, different perspectives. But the supply side, though, the issuance of treasuries is going to be historically high. And if you're issuing 1.5 to 2 trillion, you could even think of the supply as infinite. And the price of anything whose supply is infinite is not very high. Now, I look at this and I think that we really are in an era where interest rates are going to structurally be higher. You just can't keep issuing 1.5, 2 trillion in treasuries every year and expect interest rates to stay low. They'll be bought for sure, but at what price? 10-year at 3.5%? I don't think so. So I know there are many who disagree with me on this, but this chart is not something that you would have seen even a few years ago. All right. Okay. Last thing I'll talk about today is the modestly positive non-farm payroll report. So in the macro data world, non-farm payrolls are tier 1 data. They are really important market moving data. And it looks like payrolls beat expectations, 250,000 jobs created in April. Most notably, of course, average hourly earnings were also pretty solid as well. So again, it's painting a picture of the U.S. economy as basically fine, continues to create jobs at a good pace, and here you go, average hourly earnings increased by 4.4%. Okay, so the U.S. economy seems to be fine, notwithstanding everything that people are talking about or the poor sentiment. People are getting jobs and people are making more money through their wages. Now, inflation has gradually come down as well. So we're at a point where the wage gains that people have are just about outpacing inflation. It really depends on what level of wage you are. Low-wage workers have been outpacing inflation for some time. And that seems like a good thing for the broader economy. Another really good thing to note is that labor force participation for prime age workers, so workers 25 to 54 years old, has exceeded its pre-pandemic high. So it's 83.3% now. So there's been a tremendous recovery in the prime age employment demographic group in labor. And that's not surprising to me. Of course, wages are growing at 4 or 5% a year. That's going to draw more people in. Again, the peak was 83.1 pre-pandemic, and now it's 83.3. What's changed, of course, is that the labor force participation for those who are 55 and above, the older demographic, the boomers. Now, the 55 and above labor force participation was around 40% pre-pandemic, and it's just plummeted to 38.4%, and it did not rebound, and it doesn't look like it's going to rebound. And I think that's the big reason for labor market tightness. We just lost a lot of workers who left and didn't want to come back. It could be that they're concerned about health. It could be that, well, if you're a boomer, honestly, you did really well in life. You bought houses when they were cheap. Now you rode the wave up in house prices and asset prices, and you can easily retire if you want to. But if they're not coming back, that means that the labor market, of course, will structurally stay strong. All right, so that's all I've prepared for today. Thanks so much for tuning in. Next week, we have to focus on CPI because, of course, the Fed focuses on CPI, and the Fed is the most important force in markets these days. All right, talk to you guys next week.